If you've got a home equity line of credit or a HELOC, you might think you're sitting on a financial gold mine. But hold your horses, because there's a good chance you're using it completely wrong. Imagine getting a tool designed to make your life easier, only to use it in ways that make things worse. So let's dive into the common mistakes people make and how you can avoid them. Mistake number one is using a HELOC for everyday expenses. That's weird that that's a mistake. We talk about velocity banking and we tell you, use your HELOC for everyday expenses and bills.
I'm just going to rephrase that. Using a HELOC, not just for everyday expenses, but using a HELOC for everyday expenses only.
Make it make sense.
See, a home equity line of credit is a pretty powerful tool. It's open-ended. You can get money into it and you can take that income that's sitting inside of it, or a cash flow that's been holding down the balance, and you can actually pay for things out of it. So it can be used as a credit card. And a lot of people only use it as a tool to just pay off those everyday expenses like gas and groceries and things like that. But you're missing a huge opportunity. That line of credit can actually allow you to be able to use the same dollar multiple times. And in the process, it should be used to maybe not just only pay daily expenses, but also there's an opportunity to consolidate other debts. There's an opportunity to take chunks out of this debt tool or debt weapon to be able to address other financial goals you might have. If you're using it like the tool that it was designed to be used for, as that balance reduces, there's more and more liquidity there that's available to you to be able to take action.
Mistake number two is not having a proper repayment plan.
Yeah, and with any vehicle, especially a line of credit like this, not having a repayment plan can be quite impactful. What do I mean? Well, see, most lines of credit only require an interest-only payment. So if you are treating your line of credit like it's just a basic credit card and only addressing the amount that's owed at the time, that interest can continue to grow and impact your ability to have more to leverage, or cause you to put yourself in a position where you might be over leveraged, which also is what leads us to our next mistake,
which is over leveraging your home.
One of the biggest mistakes here is not fully having an understanding of your cash flow. And as a result, just because a bank offers you a $100,000 line of credit doesn't necessarily mean you should get one. You should base the amount of the line of credit that you have off the amount of cash flow that you have currently to be able to repay or address that debt. And note, if you're using your line of credit to be able to consolidate debt, that means their cash flow is going to increase. So take that into consideration when you're trying to identify how much you should have. Because just because you can qualify for a large amount doesn't necessarily mean you should get a large amount, because putting yourself in an over leveraged position can do many things. One, it could cause your credit score to be impacted because your utilization has gravely increased. And in addition to that,
just because you have it doesn't mean that you should use it. This quickly turns into a Disneyland loan.
So in essence, be mindful of your borrowing limits, because the biggest key here is just because you have access to a large amount doesn't mean you should leverage and or use that amount.
I'm going to add upgrading your home. Most people assume that it increases the equity or the trend fades and they need to upgrade again. Do you have adequate retirement funds, financial security? Can you justify the investment, or is it just purely for cosmetic reasons? Prioritizing these things now may mean that you'll wind up having to downsize into an ugly home later.
Allow your cash flow to dictate how much you should use over time, and be conscious of what that amount is. And here's what I mean. How quickly would you be able to pay it back? Giving a simple example, let's say you've got a $100,000 line of credit and you've got $5,000 in cash flow every month. Well, 5,000 times 12, that's 60 grand a year, which means if I've got a $100,000 line of credit, in essence, I could literally pay down $60,000 every year. Well, me using closer to that limit isn't as impactful because I have such a large amount of cash flow, I can pay it off fairly quickly, so I won't get myself in trouble. But if I only have $1,000 in cash flow and I have a $100,000 line of credit, how long would it take that $1,000 of cash flow to pay back that large line if I'm maxing it out? Obviously, there's a much larger period of time there, and God forbid something happens, I'm now putting myself, putting my home, putting my credit worthiness in jeopardy because of this larger debt.
And the total amount, including your interest, is what leads us to the next mistake, which is not paying attention to variable interest rates.
And this is a big one, because again, a lot of times people grab these lines of credit and they assume they're just a big credit card. And if you assume that, you can get yourself in trouble. In most cases, home equity lines of credit have a variable interest rate, meaning it may start out as one rate today, but it can increase on you. So being conscious of that and understanding how that impacts the larger balance, meaning while that interest rate is at its lowest point, you want to be dumping as much income as you can into it to bring that balance down as low as possible. And that way, as the interest does change or does increase, it's less impactful. And just so we're clear, we talk a lot about interest rates increasing, but with the home equity line of credit, the interest rate can also decrease. So it can also work positively in your favor as well. But being conscious of the fact that, hey, I know this is a variable interest rate, so therefore I need to make sure I'm using it as the tool that it's meant to be used as, not parking, I'll call it debts, on the home equity line of credit and not paying it off, making the interest only payment, which means the balance isn't really moving. It could be as detrimental as that balance that is currently on that line of credit is at one interest rate today, but you let it sit there over time. It could actually be at a totally different interest rate, which could cause you to be over leveraged.
And not paying attention to a variable interest rate means you end up paying much more than you had initially agreed to. And mistake number 5 is not using a HELOC strategically.
And this is a big one because the last thing you want to do is treat your HELOC like it's a separate loan. What do I mean? Hey, I've got my normal checking account and I pay my normal bills from that normal checking account. And in addition, I've got this home equity line of credit that is totally separate from everything else that I'm doing, separate from my mortgage, separate from my car. And so therefore, I'm just going to pay the normal monthly payment that is due on that line of credit. Keeping things separate can be very impactful to your ability to be able to get yourself into a much better financial position. Another mistake often made is not being aware of your weaknesses and or limitations around your relationship with money. It's important because if you approach this line of credit like you've always used all of the other vehicles that you've used in your life related to paying debts like a regular credit card, you can get yourself in a position to where you are increasing interest faster than you were maybe prepared for and causing yourself to be over leveraged. The best thing you can do is use your home equity line of credit as a tool. Sometimes some people call it a debt tool or a debt weapon, but it's meant to be used as both a checking account and as a vehicle that you can not just pay expenses from, but also use to consolidate debt and also invest from. Why? As you drive your income through the line of credit, it brings the balance down to its lowest point. At this point, you're paying the least amount of interest, but you also have full access to all of the equity that is now dropped inside of that line of credit. Now, this is an opportunity to take that equity that you have, take that room, that line of credit that you have, to be able to do other things, make investments outside of your line of credit to be able to improve your financial position, or consolidate debt or pay expenses. But it should be used as a tool or as a weapon where money comes in and money comes out. It's an open-ended product. It is designed to be leveraged. It is designed to be used to be able to improve your financial well-being. So the key is, if you're going to use a home equity line of credit, you want to make sure you're treating it as a tool. It is designed to be both a checking account and a vehicle to be able to pay debt from as well.
But most people are looking to use a HELOC to pay off their mortgage faster.
But hold on, let me let you in on a little secret. While we're talking about paying off your mortgage, from my perspective, from our perspective, paying your mortgage off is actually the last thing that you would want to do if you have access to a debt weapon like a home equity line of credit. I am a fan of getting multiple uses out of the same dollar. And what that might mean, instead of paying off the mortgage, instead of paying off the home, how about we put that money to work so we can get our money working for us and then put us in a position financially to where if I wanted to pay off the home, I could use the vehicle that I've grown using the leverage from my line of credit to be able to pay off the home if I choose to.
So now that we've uncovered the common mistakes to avoid when using your HELOC, you're well on your way to maximizing this powerful financial tool. But wait,
There's far more to mastering this mortgage payoff strategy. We've only just scratched the surface here. What I'm talking about deserves its own video.
and if you're serious about paying off your mortgage faster and smarter, you need to know the pitfalls of some popular advice out there. And some of them you shouldn't be using. I bet you've heard a lot of advice out there. So follow this video to watch 5 popular mortgage payoff tips that don't work and what to do instead. There you'll learn what you should really be doing to achieve financial freedom faster. We'll see you there. Just click here. Do it.